Welcome to Northwest Arkansas Investing Podcast, your go-to source for real estate investing in Northwest Arkansas.
Whether you're a seasoned investor just starting out, we bring you expert insights, market trends, and practical strategies to help you build wealth through real estate.
From buying and selling to property management and long-term investment planning, we cover it all so you can make smart, informed decisions in this fast-growing market. Let's dive in. All right, welcome to Northwest Arkansas Investing Podcast. I'm here with Mr. Brian Wagers, my co-host, and we just got done talking through deal structure and partnerships. And so if you haven't listened to that one, hop back over there. We did a quick 15-20 minute segment on that. And our next episode, we just wanted to talk through, underwriting tips and just how we're evaluating deals today with how the market has shifted and with the effects of inflation over the past 5 years, and really just kind of how we look at deals. And I think this is an episode that I would have loved to have in my back pocket if I was getting started. But even just as an experienced guy and kind of hearing, Brian, how you're seeing it, same thing with me and kind of some of the smaller multifamily and stuff like that. And so I think something you'll hear from a lot of big names. I always say Grant Cardone because I've watched him for years, but Grant always said that he even when he wasn't able to buy deals, that he was underwriting 100 deals just to understand it, 100 deals a month or 100 deals every 6 months or whatever. And so even I would say just starting out, even my advice would be deals that come on the market in Northwest Arkansas, a duplex or anything that you see out there, I would just encourage you to underwrite it and understand, is this a deal? A lot of what comes on the market nowadays, especially if it's smaller multifamily, is not going to make sense. But I think it's important for an investor to understand that and understand what levers are being pulled today, which we'll get into. But yeah, I think just from a market check real quick, a market reality check, I just went to the Skyline report in Washington County last week. I know they've got the other ones coming up, and then a lot of that data will drop, which we'll talk about soon. But everything you've seen, where do you see rents trending in Northwest Arkansas?
Man, that's a good question. I think it depends on A, B, and C. And to really get a good grasp on that is to do exactly what you just said, is underwriting deals that are on the market and deals that have traded. That's what I first did when I first got started in commercial real estate. I was on LoopNet and just analyzing these deals that had been sitting there for a while and seeing what made sense.
Mm-hmm.
And so same thing when I was doing, when I was going after my first single family, I underwrote, 20 deals before I got that first one. So it's a great practice. As far as where rent's going, A class, there's a lot, anything that is being built is A class. It's hard to build a C class product. So there is a lot of A class coming online. But at the same token, 36, people are moving here, I don't know, a day.
Per day, yeah.
A day is what the last statistic has. So those guys are usually moving here for Walmart, Tyson, J.B. Hunt, University of Arkansas. So it's a lot of white-collar jobs. So they are wanting that premium product. They may not want to jump into their first home. They might want to get a feel for the area. They may only be here on a 1 to 3 year stint, so they may not want to buy a home and go through all that. So they're wanting for a nice place to live, and they're looking for a new build rental, whether that's a home or an apartment. So, I think local investors see the cranes in the sky and seeing all this new build come in. You might think, oh man, there's a lot, but it's getting absorbed. We'll see on the Skyline report. I think there was a softening on the A-class rents, where it was, rents were increasing, 5 to 10% a year or more,
mm-hmm.
On some properties. I think right now I would underwrite for 3% rent increases. Now, where you start that is really just depends. I think for A-class product, you're seeing around $2 a square foot on rental.
Mm-hmm.
For C-class, in C-class in Fort Smith, it's $1 a square foot.
Yeah.
C-class and NWA, anywhere from there to $1.50 or more. So it really depends on what submarket you are in, if you're in Fayetteville or in Rogers. And Rogers ranges quite a bit too. And so does every submarket. So what are you close to? I would really dive in on your comparables. So, any kind of deal I'm doing my own market survey. So I'm looking at all the comparable properties to me within 1 to 5 miles, preferably 1 mile to 3 miles, but I'll have some comparables to go out further. Sometimes you might not have an apples to apples comparison. You might, be having you might have a 2000, something that's built in 2000 and everything around you is 1980s build. So you might have to go back, go a little bit. So I would suggest, almost looking at, okay, what are these older properties that are renting very close to me, and then what are these newer properties achieving that are a little further out, and try to come up with somewhere in between there. So there's still a large demand here in NWA. You're seeing this, the Whole Foods apartments projects, those are coming online. It's like Alta or something, Vista at Alta. I was looking at a Rogers project here recently. The rents were everywhere from $1.60 to like $2.60. Wow. But that, and then there's the Northgate new apartment complex going by Ruth Chris. That they had it advertised for $2.60. But if you dive in, they're offering $1,000 off the first 2 months. So that's going to hurt your overall. You're giving up a lot to concessions and leases. So you're seeing a lot of that with the A-class product. There's a lot of concessions and loss to lease. So you have to factor that in on the new product.
Yeah, absolutely. And I've even started to see it a little bit in like B and C class stuff, that just offering maybe first month rent free on a 12-month lease, which I don't think we've seen in a while. So still really interesting. Went to the Skyline report too, which again we'll talk about a lot of that data coming up, but vacancies still continue to be really low, especially in areas like Springdale specifically, which I know you've got a deal coming up there, and then Fayetteville is still very low in those 1-2 bedrooms specifically, and then even 3-bed for the most part. Both of those cities are super low, so it'll be interesting to kind of continue to see. But I know rents with vacancy being so low and there not being that many units. And a lot of these units that are being built are being absorbed. Rents just kind of naturally are going to continue to climb slowly. And I think it's good to have that conservative look around 2 to 3%. So when it comes to expenses, though, so we talked about rents and kind of what we're seeing there. When it comes to expenses and when you're underwriting a deal and looking at what that looks like. A lot of times, you can use calculators out there. Bigger Pockets has a calculator that a lot of people use when you're underwriting deals, and they have like an insurance calculator on there. You can basically use which obviously is not going to be the most accurate, but at least spits you out kind of an idea of what insurance will be. But you can plug in details about the property, maybe roof age, unit age, stuff like that, and then it'll spit you out kind of an estimated insurance quote, so you can kind of be able to underwrite a little bit quicker on that. And then property taxes, payroll, some other stuff like that. Property taxes specifically too. How do you look at that when it comes to, let's just say you're looking at a smaller deal first, and property taxes are maybe showing $2,000 a year. How do you look at how you input that into your underwriting? Because obviously when it trades, it's going to be reassessed at some point in the next year to 2 years. Do you project that in your underwriting, or do you plug in what's currently there? How do you look at stuff like that?
Yeah, 100% do not plug in what's currently there on insurance or taxes. Taxes and insurance are going to be your biggest, deal killers, I guess you could say. Definitely account for both of them to come up. I would try to have a couple live insurance. I would get insurance quotes on some properties that you're looking at to get an idea of what they're going to be at. 100% increasing that. Property taxes anywhere from 30 to 50% increase from what the previous was, depending on how long they've owned it. They may have an incredible basis where their property tax is still based on, hasn't really increased yet. Arkansas is good for it. Some other markets where it's 30% of the assessed value. I think maybe as low as 15% to as high as 30%. So definitely increase the property taxes, increase property insurance, and you can even get consultants on that. I kind of smiled when you said the bigger pockets calculator. I used to use that. Now, I mean, for development deals, I pay an analyst, $250 an hour to analyze, like an institutional analyst, to go over all assumptions and to really build out a model for each project to account for, the construction period, to account for the lease up period, to have different scenarios if construction costs are up or if rents are at X, what happens here, to run different lease up schedules. What happens if we're leasing 5 up a month or 10 up a month? So your level of underwriting can really change. But there's a lot of good models out there. I would use different ones. I think as far as for expenses go, insurance and property tax are the big ones. Definitely want to what I see very commonly for the smaller ones is it's a mom and pop run property, and their expenses are very low. They're not putting much into unit. They're not accounting for unit turns. They're not accounting for paying property management or payroll. So that's not on there. So sometimes these guys are running it at 30% expenses, but in reality, when you take over, you're going to be putting more towards these units as they become vacant. You're going to be putting in professional property management unless you're managing it yourself. So, as I've seen as low as 30% for new build, like realistic new build, like brand new 2025 build. You're not going to have, turn up for that first year or so. It's going to be very minimal. So 30% is seen in the market as kind of the base for a new build, anywhere from 30 to 35%. And then, I've seen expenses as high as 55%, depending if the owner is paying for utilities. In Northwest Arkansas, much more common for the renters to be billed back for water and electric and cable, or even set it up themselves too. So you definitely want to get clarity on that.
Yeah, that's a great point. Something that I've run across a lot lately with some older properties, C-class for the most part, is something that they typically aren't like talking about openly, or have that maybe sometimes don't even have it on their P&L is like water, like utilities specifically. Maybe they're not individually metered on their water or something like that, but they're so the owner pays for that, but sometimes they charge back tenants for it, sometimes they don't. Like that, those are things to be thinking about as well. And we'll get into some more expenses, but things to look out for, stuff like that. But I just thought of that kind of from that, and
I think that takes us exactly to the next point. So what to gather for this whole underwriting process, and the first thing is how the property has performed the last 12 months, and how is the property performing today. And so what you want to get is what's called a T12, which is the trailing 12 months of profit and loss, and what the current income is today. And that can usually be shown with a rent roll or with leases. So you're going to see what it is today and how it's performed the last 12 months. If you want to do a deep dive, you could even go 24 months and 36 months to really uncover some, maybe they had, huge water expense. You might find out there was some plumbing issues if you go a little bit further back. But that's the first step, is how has the property performed the past 12 months and how is it performing today?
Yep. And again, just look into, and with some of the calculators that you may use out there or models, there will likely be a section where you can, what does the property look like at current rents? What does the property look like at market rents? If you don't have a calculator like that, email Brian or I've got one for sure I can send you. I'm sure Brian does as well. Happy to send that to anybody for free. But yeah, number one would be understanding your rent comps, how the property's performed the last 12 months at least. And then from there, kind of building out a pro forma income. Brian, for those that don't know, what does a pro forma mean?
Yeah, it's a projection of how you're going to run the property. It's pretty much a business plan, in an Excel spreadsheet or whatever model you have. It's how we expect to stabilize expenses, or in some cases, how our expenses going to go up, and then how are we going to boost income. So you're going to want to look at how it's being run today, and that can be your start. And you might see these guys are charging an average of $1,200 in rent, but market clearly says we can charge $1,400 for the same thing. What I commonly see also is they say, okay, all of these 12 units that's going to happen day one. This commercial property now is all of a sudden at our pro forma rents. You want to make sure that's gradually coming in, whether that's 3 months, 6 months, 12 months. I think 12 months is reasonable. It depends on how long the current leases are, how long the current renters are in there for. What's their current agreement? Is it month to month, or are you going to be stuck with them for a little while so you can't really push that rents? And sometimes you're going to have to make improvements too. So once a resident gets out, then you have to come in and make those improvements to the property, and then you have to fill someone else out there. So it's not going to be day one you close on the property and they were charging $1,200 and now all of a sudden it's $1,400. You want that pro forma should show it being gradually brought in.
Yeah, that's a great point. And then one other point to that too, something to watch out for, Brian. I'm sure you've seen this all the time, but what you'll see out there. Let's say a property comes up on the market. Brokers will oftentimes be marketing their pro forma. Maybe it's a pro forma 6 cap or something like that, or a pro forma, what the pro forma would look like, and not really. Obviously, they want to show what it could be, and not maybe you have a property that's way underperforming in rents and things like that. And that's really what you want to dig into first, and then kind of start to back into it, understanding market rents and look what a pro forma could be. But just something to look out for as you're through that underwriting process. And then just like another big item, this is going to be one of the biggest in my opinion, is expenses and just kind of layering those in conservatively. Some things that come to mind here, maybe our management fees. Maybe some beginner investors will be looking at deals with a 0% management fee because they're going to do it themselves. I would recommend even underwriting it with management fees because most people, maybe won't have the time to manage it themselves and stuff like that. So that could be something that could be anywhere. There are shops out there, I think, that will do it for pretty inexpensively. I think it's an area that is super important, though, and you get what you pay for here. You could probably have a lot of management. I've seen management fees out there that will do it for 4 to 5%. And others that will be up to 10%, or maybe they go higher than that. But this is an area that will be one of your number one partners in the deal, and that are going to kind of help you continue to stay upon those market rents. And typically, if they're a good manager, they're gonna pay for themselves. And then just some other things that I think about, Brian, you can add to this on the expenses piece, but something that I think a lot of people don't underwrite for, especially the beginners, are maintenance fees, just I guess kind of set aside money for maintenance, just common maintenance that's going to come across units, and then same thing for vacancy reserves for both of those. Obviously, those aren't things that are, you close on the property and tomorrow you're going to have an expense for, but I think having reserves for maintenance and having reserves for vacancy is important. What are your thoughts on those? Are those common items that you're also underwriting with?
100%. You're going to have your day one CapEx, what we're doing to spruce up the apartment, or commercial property, or single family, or whatever it is. You're going to come in, hopefully spend money right away so the residents know that they're getting new ownership. But like you said, the maintenance, also known as CapEx, you want to set aside money for CapEx unforeseens that are going to happen, and that's going to be unit turns, that's going to be HVACs, that's going to be possibly new roofs depending on the age, and you're wanting to set that aside every month. It's not a bad idea to have a maintenance replenishment where a certain amount of your income is going towards, a CapEx budget for that rainy day where you might need it. So 100% on what you said on the management, make sure you're adding that anywhere from 3 to 10%, depending on the type of property, single family being the highest percentage, and then lowest, large tenant based property.
Yeah, that's a good point. And then just some other items that we're looking at typically in the underwriting process. An item that I think will be really important to banks typically is your DSCR, which would be your debt service coverage ratio. A number that you'll see out there a lot is 1.25 debt service coverage ratio. I guess number one, Brian, just in layman's terms, how would you explain that to a beginner?
Yeah, so debt service coverage ratio 1.25 means that you have 25% of income over all your debt and expenses. So if you're covering your expenses, your utilities, your management fees, and the debt payments to the bank, how much extra are you going to have at the end of the day? If all that's $100,000 and you're bringing in $25,000 of cash flow, that's a 1.25 DSCR. So usually banks want to see that you're able to cover all the expenses and their debt payments at least with a 20% to 25% gap is what I've seen. 1.2 to 1.25 is going to be the minimum. So same thing on the investor side. You want to make sure that you have that for, again, for that rainy day cushion and for cash flow for your investment. You want that distributable cash to start getting your money back.
Yep, absolutely. And I think that's a great point, and something that you're going to want to be able to go to a bank and say, here's the financials, here's the pro forma of kind of what we expect it to perform at once we have it stabilized, and that kind of gives us that DSCR, that debt service coverage ratio that we talk about, which will be an important thing for the banks.
And that can change too from your day one DSCR to your stabilized DSCR where you have, once you've spent that money and once you've increased those rents, that can jump up quite a bit.
Yep, absolutely. And then I think kind of one of the biggest last things that we're looking at when it comes to the underwriting process is just looking at, what is our exit and kind of understanding, hey, this is a business plan. We're putting together a business plan to show the bank and to show our investors if there are partners in it. And how do we expect to get out of this if we, if it's going to be in 3 years, if it's going to be in 5 years, if it's going to be 10 or more years, understanding your cap rates and what that exit looks like, I think is really important.
Cap rates, definitely want to stress test different cap rate scenarios that, interest rates have a lot of upward and downward pressure on cap rates depending on what the next buyer is going to have to borrow at. The type of asset is going to have a big factor in that. If it's a brand new build, your cap rate is going to be lower. If it's, right by Walmart's home office and it's in Bentonville and it's brand new, you're probably paying a pretty low cap rate. I've seen it below 4 caps, and as high as 10 cap in a, market like Memphis, Tennessee, where it's above a 10, or it's a different type of asset where it's a mobile home park. Those might, the appreciation is going to be harder there, but you should be getting more cash flow on those type of investments.
Yep. And then, for those that don't understand, cap rate would be your capitalization rate. And so if you were to, what that means, if you were to buy the property cash, what would your return be? And I think as an investor, understanding what cap rates are for certain types of asset classes, if it's commercial or if it's even small multifamily or whatever, and then depending on the asset type, if it's A class or B class or C class, and then even looking down to certain areas, something in Springdale, the cap rates in Springdale are obviously going to be a lot different than your cap rates in Bentonville or your cap rates in Fayetteville. And so I think as an investor, as you are underwriting deals, it's going to be really important to kind of understand what those look like so you can know what your exit could be, with that business plan. So,
yeah.
Brian, just as we wrap up this piece, I think we could talk about this all day. Underwriting is such an art, and I think a lot of investors need to really understand it. But what are some common mistakes that you've maybe seen in business that you've done in the past, or maybe others around you, that you feel like they underwrite a little bit too aggressively? What do you normally see are those kind of shortcomings?
I would say three things: underestimating expenses, overstating rent growth, and overstating that rent growth too fast. Saying, I think we can turn this property around and get rents to X, making sure that's spread out a little bit, and then your end sale price assumption being too high.
Yep.
Making sure you want to stress test different cap rates, making sure even if the cap rates do go up, that your deal still makes sense there.
Yeah, absolutely. And I think I really like what you said about overestimating rent growth. I think, obviously if you're just getting started, or maybe you've been in the game for a little while, we have seen some outrageous, rent increases over the past 5 years. And just for those that are looking to do deals in the future, I think it's going to be important to understand historically what rent growth has looked like. It's not going to look like what we've seen in the last 5 years, but it's a result of, we've seen the government print 40% of our money supply in the last 5 years, which is insane. So you can imagine that that's obviously going to have an effect on our rent now, and it's probably safe to assume it's probably going to be closer to what the inflation rates are today, 2 to 3% in there, something like that. Is that kind of what?
Yeah, I would say for me, like I want to make sure this deal makes sense at today's rents. Like if we assume that rents aren't increasing and it's just some market rate, I want to make that the deal needs to make sense of that, and then push rents from there.
Yep, agreed. And I like what you said down here. Good underwriting keeps you out of trouble. I think really understanding the best case scenarios and worst case scenarios, and being able to live with those worst case scenarios if they happened, and it wouldn't put you in a bad spot, is really important. I think even on top of that, nowadays, especially, I think now is more than ever is the time where I think it makes sense not to be fully leveraged to the nines. With the way kind of the economy has continued to fluctuate up and down, and what we've seen, and how rates may look in the next few months. I think it's probably a smart play to 25% down, 20% down. A lot of these banks are requiring that nowadays, and so I think understanding, number one, not being too leveraged, but number two, understanding conservatively, is the deal a good, or is it, do you need to pass, and not being emotional about those things, if that makes sense.
Yeah, 100%. Leverage is a whole nother topic we could get into as far as, what's the right amount of leverage. And I think it's just make sure your underwriting is sound, and make sure whether you're doing the underwriting or whoever you're working with is doing the underwriting is getting real-time feedback. Where have they talked to these insurance agents? Have they talked to any tax consultants? Have they talked to property managers? Have they talked to other owners? And making sure that's real time, not too hypothetical.
Yep. Love it. Well, I think this is such a good episode. We could go on forever about this and underwriting, and kind of continue to go into that. But if you have any questions and want to reach out to Brian or I on how we underwrite, what tools we use, we're happy to help, send out the tools that we use, and we're happy to kind of be a sounding board there for anybody that needs help there and is just kind of thinking about wanting to kind of go in here. So thanks for listening to another episode of Northwest Arkansas Investing Podcast, and we'll see you next time.
Thanks, guys.
Again, thank you guys for tuning in. I'm going to go ahead and list some sponsors off here. We're going to start with Whinstone Private Lending. This episode is brought to you by Whinstone Private Lending, one of the top private and hard money lenders now serving Northwest Arkansas. Whether you need short-term capital for a flip, a bridge loan, or creative financing, they've got you covered with very flexible products to fit nearly any deal, including 100% financing. What sets them apart is their deep expertise, fast response times, and ability to think outside of the box to help investors like us close quickly and efficiently. If you're looking for a real lending partner, check out Whinstone Private Lending. Link is in the show notes. Sponsor is Advantage Title and Escrow. They're a local company. They do great work. Specifically, Kayla Phillips. I can speak personally on this sponsor because I use Kayla for all of my transactions. It's been 2, 3, 4 years now, and Kayla and I have done a ton of deals. We probably do between 65 to 80 deals a year together, and they do a great job. The SOPs, so systems and processing that they have over Advantage Title, is just incredible. Clients love it. They do a great job from start to end communicating. When I give a deal to Advantage Title and Escrow, I know that it's going to be taken care of. There's no second guessing. I almost am able to treat them like a second transaction coordinator to my transaction coordinator that I already have. I know that they're going to handle the systems and processes correctly. As an agent, as a homeowner, as a buyer or seller, they do an incredible job of handling a transaction and communicating throughout the process. They do a great job with communication, especially Kayla Phillips over there. I would highly encourage you, if you're looking to close on a home, buy a home, if you're an agent listening, to use Advantage Title and Escrow, specifically Kayla Phillips. So you're going to reach Kayla best at 501-358-1601, or you can email her, Kayla, Cayla, at goadvantagetitle.com. Advantage is ADVANTAGE title.com. Banks are about community, and Century Bank of the Ozarks has been your community bank for 131 years. That's over a century, since 1894. They've been helping neighbors build homes, grow businesses, and plan futures. Because they're locally owned, your loan approval happens here, not miles away. Visit their locations in Fayetteville and Mountain Home, Arkansas, as well as Gainesville, Theodosia, Bakersfield, and Ava, Missouri. Century Bank of the Ozarks, local bankers make local decisions since 1894. Member FDIC and equal housing lender. If you enjoyed the show, make sure to give us a follow on your favorite podcast platform so you never miss an update.
Don't forget to connect with us on Instagram, Facebook, and LinkedIn for more real estate insights and behind-the-scenes content.
Have a question you want us to cover? Send it our way. And if you're interested in sponsoring the show, visit NWAinvesting.com to get in touch. Thanks for listening, and we'll see you next time.